If the market crashes in 2026, and history says it will, most people will panic, sell, and lose years of progress. But a small group will do the opposite and quietly build generational wealth. This video is not about hype, it's about positioning before the headlines force everyone else to react. The 2026 market crash is not a random event. It is the delayed consequence of decisions already locked into the system. Exploding national debt, persistent inflation pressure, fragile consumer spending, and an over-financialized economy have created a structure that cannot unwind quietly. Every major crash in modern U.S. history followed this same pattern: excess liquidity, false stability, and then sudden repricing. What makes 2026 different is scale. Trillions in debt refinancing, AI-driven labor disruption, and geopolitical instability are colliding at the same moment. This is why institutional investors are quietly repositioning, while retail investors are still debating whether a crash is even possible. The danger isn't the crash itself. The danger is being unprepared when volatility accelerates. Markets do not collapse overnight. They fracture, giving signals long before headlines confirm reality. Those signals are visible now, but only if you know what to watch. This video isn't about predicting exact dates. It's about understanding cycles, capital flow, and behavior, because wealth is built by positioning before panic, not reacting after it. So, if a crash is coming, why do crashes create more millionaires than bull markets? Market crashes don't destroy wealth, they transfer it. During every major downturn, assets don't disappear, they move from emotional hands to strategic ones. The wealthy don't win because they're smarter, they win because they're liquid, patient, and positioned. In crashes, fear becomes the dominant force. People sell not because fundamentals are broken, but because uncertainty feels unbearable. This is when pricing disconnects from reality. Stocks, real estate, crypto assets, and even businesses trade at massive discounts, not because they're worthless, but because sellers are desperate. Smart money waits for forced selling, not confirmation. That's why the biggest gains are never advertised in real time. By the time recovery headlines appear, the opportunity window is already closing. If you want to benefit from the 2026 market crash, your goal isn't to predict bottoms, it's to survive volatility with capital intact. Liquidity is power. Cash is not trash during crashes, it is optionality. The question isn't whether markets will recover, they always do. The real question is who still has capital when they do. But here's where most people get it wrong. What they prepare for isn't the real danger. The biggest threat in 2026 market crash isn't losing money. It's being forced out of the game. Job instability, rising living costs, debt obligations, and emotional decision-making push people to liquidate at the worst possible time. This is why preparation is not about picking assets, it's about building resilience. Emergency liquidity, reduced leverage, and emotional discipline matter more than market predictions. Most investors fail not because they chose the wrong asset, but because they were overexposed when volatility arrived. When stress hits, psychology overrides logic. The market exploits fear, impatience, and overconfidence ruthlessly. If you want to benefit from a crash, your first move isn't buying, it's removing fragility. Simplify, de-risk, create breathing room. Because only those who can stay calm can act rationally when prices collapse. This is how crashes separate spectators from participants. Once you're stable, that's when strategy finally matters. Strategic money doesn't chase trends, it builds frameworks. In a crash environment, diversification is not about owning many assets, it's about owning uncorrelated ones. Quality equities with real cash flow, undervalued growth sectors, strategic crypto exposure, and defensive assets all play different roles. The goal isn't maximum return, it's asymmetric opportunity. You want setups where downside is limited and upside expands post-recovery. Timing matters less than structure. Scaling in beats going all in. Volatility is your ally when you're prepared. The wealthy don't buy bottoms, they buy fear in stages. This is where patience becomes a competitive advantage. The market rewards those who can wait without panicking. The most dangerous part of the 2026 market crash will not be the numbers on the screen. It will be the moment your brain starts looking for relief. This is where even intelligent investors fail. When markets fall hard, the human nervous system treats financial loss like physical danger. Heart rate rises, focus narrows, logic shuts down, and suddenly selling feels like safety. This is not weakness, it's biology. The market is designed to exploit this response. Volatility doesn't just shake portfolios, it shakes identity, confidence, and long-term thinking. That's why most people don't lose money at the bottom. They lose conviction before the bottom forms. The real collapse happens internally first. In every major crash, the same pattern repeats. Strong hands hesitate, weak hands capitulate, and patient capital steps in quietly. This psychological break is the market's true point of no return. Once fear becomes exhaustion, assets are surrendered, not sold. If you have not mentally rehearsed this moment in advance, you will not recognize opportunity when it appears. Preparation is not about predictions. It's about emotional immunity. Those who master this phase don't feel brave in the crash. They feel bored, detached, controlled. And that emotional control is what separates people who survive the 2026 crash from those who fund someone else's recovery. So if psychology is the real battlefield, the winning strategy must be simple enough to survive fear. The winning strategy for the 2026 market crash is not complex, and that's exactly why it works. Complexity collapses under stress. Simple systems survive. The playbook begins before the crash, not during it. First, liquidity is non-negotiable. Cash is not an opinion, it's optionality. Second, remove fragility. Excess debt, over-leverage, and forced obligations turn volatility into a personal crisis. Third, pre-commit to rules, not emotions. Decide in advance what you will buy, when you will buy, and how slowly you will deploy capital. This removes panic from the equation. Smart money does not rush in, it scales. It expects further downside and is comfortable waiting. That patience is not passive, it is strategic. When headlines scream collapse, the prepared investor is already executing a plan written months earlier. This is how crashes quietly manufacture wealth. Not through bold predictions, not through perfect timing, but through discipline that survives fear. The 2026 market crash will not reward intelligence, speed, or confidence. It will reward those who positioned early, stayed liquid, and refused to let emotion hijack their decisions. When recovery begins, and it always does, the gap between the prepared and the reactive will already be permanent. Because by the time the crowd feels safe again, the opportunity will already belong to someone else.